Could there possibly be another high-yielding dividend ETF fund other than JEPI, other than Q-Yield, and other than SCHD that you haven't already heard about? Well, it just might be the Invesco High Yield Equity Dividend Achiever ETF, or ticker symbol PEY. This ETF provides investors with exposure to high dividend yielding equities. PEY seeks to track the performance of the NASDAQ US Dividend Achievers 50 Index, which is comprised of around 50 or so stocks that have all increased their annual dividend payments for at least 10 consecutive years. And here are some reasons why PEY could be a great addition to any of our portfolios. PEY has exposure to high-yielding equities. They focus on stocks that have a history of consistently increasing their dividend payments. By investing in these companies, investors can potentially benefit from the steady stream of income in the form of dividend payments. So what's better than a company that continuously pays their quarterly or even monthly dividend on time? It's of course companies that increase those dividends over time. Also, maybe my favorite part of this fund is the diversification factor. PEY invests in a diversified portfolio of 50 more or less high-yield equities. This can help reduce the risk associated with investing in a single stock or company. So the reason I like this is that if there are a few bad apples out of the 50 or so stocks in this ETF, it's not necessarily going to sink the whole ship. The longer that I've been investing, long-term investing that is, diversification has been more and more of an important factor when it comes to choosing my future investments. The PEY ETF also has a relatively low expense ratio. It's 0.54. Now I know there are some ETFs that do have lower than this, and there's definitely some that have higher, but this is sort of somewhere in the middle. This means investors do pay a small fee though for the management of the ETF, but this fee is still lower than the fees that are charged from actively managed funds most of the time. The fund also has a strong historical performance, with an average return of around 8.4% over the past 5 years or so. This is a higher average return of many high-quality ETFs and single stocks over the same period. Another reason this ETF could be worth looking into is the potential for the capital appreciation. While the primary focus for PEY or other high dividend yielding ETFs like this one are to pay out investors' income, PEY also has the potential for capital appreciation as the value of the underlying equities increase over time, which I love to hear once again as a long-term investor. Also, PEY has a relatively conservative approach to investing, which I would sort of match that with my investment profile honestly, and comment down below if you guys would consider yourselves sort of conservative investors as well. PEY has a conservative investment approach with a focus on high-quality dividend-paying companies. This can help reduce risk associated with investing in high-yielding equities. So in a minute here, we are going to go through PEY's holdings. But let me tell you, they are definitely some strong, sort of boring companies, which I absolutely love. So now getting into the good stuff, PEY's current trailing 12-month dividend yield is around 4.2%. And it pays out around 7 cents per share per month. PEY has a consecutive years of dividend growth of 9 years and consecutive years of dividend payments 17 years. A simple look on the max dividend history view, you can tell that PEY, ever since really 2008-2009, has consistently paid out every single dividend on time and also been raising their dividend quite consistently. PEY's top 10 holdings are as follow. They have Altria as number 1, Telephone and Data Systems number 2, Verizon, Line & Basel, Healthcare, Kennedy, Wilson, Philip Morris, Universal Corp, WF Corp, Franklin Resources, and others. There's more or less 50 names in this portfolio, so even if there are a few stocks that underperform, the rest of the portfolio should hopefully hold it together. This is where things get sort of interesting. If you look at the total return of PEY over the last 5 years versus the S&P 500, PEY has returned 46.56%, where the S&P has returned 61.93%. So it has underperformed the S&P 500 as really mostly everything does. I mean, the S&P 500 is sort of the gold standard. But what's sort of interesting is that if you compare PEY to the S&P and then also add in JEPI and SCHD, SCHD is number 1 at 75.48%. SCHD is an absolute monster of an ETF and one of my other favorite holdings. But interesting enough, JEPI underperformed PEY by around 5% more or less, if we're talking about total return goes. So is PEY one of the highest quality, higher yielding dividend ETFs? I would consider it one of them on the list. But truthfully, for me personally, I have a very diversified portfolio with various stocks in various industries and different ETFs that all have different strategies. Diversification is definitely key, but PEY might be an ETF to look into. If you enjoyed this video and you want to see more videos like this, make sure to please drop a like in this video and also subscribe for more. Thanks again as always, and I'll see you in the next one.